Welcome back to the Daily Crypto Deep Dive. The crypto market has a rhythm to it, a kind of internal pulse that becomes obvious once you've lived through enough cycles. Bitcoin moves first, the market breathes, and then, almost quietly at first, the rotation begins. And when the rotation starts, it almost always catches retail off guard, because it doesn't begin with the small caps or the hype coins or the flavor of the month projects. It begins with the majors. It begins with the assets institutional money is comfortable holding. And it begins with subtle shifts that show up first in the data, before they ever show up on a chart. And that is exactly what we're seeing right now. For the first time in weeks, ETF flows have flipped. Bitcoin ETFs have seen outflows, but Ethereum, Solana, and XRP products have seen inflows. And that one detail, on its own, may not seem dramatic. But when you combine it with improving liquidity, stablecoin positioning, and the macro backdrop heading into the Federal Reserve decision, it becomes one of the clearest signals we've had in a long time that institutional capital is rotating, not exiting. And that's the story we're breaking down today. Because altcoin rotations don't start with fireworks. They don't begin with 20% daily candles or viral chart screenshots flying around social media. They start with directional capital quietly shifting from Bitcoin into the next layer of assets. They start with ETF flows picking up in places most people aren't watching. And they start when the biggest, smartest pools of capital decide that Bitcoin isn't the most efficient trade for the current part of the cycle. That is what makes this moment so interesting. On-chain data, ETF flows, liquidity conditions, and trader positioning are all pointing toward the same conclusion. The rotation has started. When Bitcoin sold off brutally in November, falling from the 120,000 region down into the 80s, the entire market was shaken. Leverage was flushed out. Retail confidence evaporated. Analysts were scrambling to figure out whether the top was in. And during that chaos, something important happened. Liquidity dropped across the board. Stablecoins left exchanges. ETFs saw withdrawals. Funds reduced exposure to ride out the volatility. It was the kind of environment where rotation simply cannot happen, because rotation requires one thing above all else: available liquidity. Without liquidity, rotations die before they even begin. But now, the story has changed. Coinbase Institutional highlighted this week that global liquidity has started to improve again. Treasury flows, global credit cycles, and even foreign bond markets have shifted in a way that creates more available capital. And historically, crypto reacts before equities do when liquidity returns. It's one of the features of the asset class. It is hypersensitive to every uptick in dollar availability. And when liquidity comes back, Bitcoin is the first to respond. That's the phase we've just experienced over the past 48 hours. But the second phase, the one we're stepping into now, is rotation. This return of liquidity is showing up not just in price action, but also in stablecoin behavior. Stablecoin dominance dropped slightly over the last few sessions, which may sound like a tiny detail, but it's one of the most reliable indicators of sentiment we have. When traders are nervous, they sit in stablecoins. When they feel confident, they deploy stablecoins. So when dominance drops while exchange balances rise, it tells us that capital is preparing for movement. And when that movement begins during a macro event week, especially one that involves a Federal Reserve decision, it tends to favor the assets that have the most upside relative to their recent performance. That's why Ethereum, Solana, and XRP are at the center of this deep dive. These are the assets institutions rotate into first, because they carry high liquidity, low slippage, and strong narrative potential. The ETF flow data adds another crucial layer. An article today pointed out that while Bitcoin ETFs recorded meaningful outflows, the ETFs tied to Ethereum, Solana, and XRP posted fresh inflows. This is not noise. ETF behavior is one of the cleanest windows into how institutional allocators think because these vehicles are designed for large, regulated pools of capital. They tell us where pension funds, hedge funds, and corporate treasuries are positioning. And when we see Bitcoin red while Ethereum and Solana are green, the message is simple. Smart money is repositioning. But the question is why? Why rotate now? Why rotate before the Federal Reserve decision? The answer lies in risk-reward. Bitcoin has carried the market for months. It led the charge during the ETF boom. It survived one of the worst sell-offs of the year, and it has recovered strongly. But institutions aren't simply looking at which asset is safest. They're looking at which asset has the most attractive upside to downside ratio at this specific moment. Ethereum, Solana, and XRP each offer something Bitcoin doesn't right now: asymmetry. They have more room to run if liquidity improves. They have strong fundamental narratives, and they have investor demand building beneath the surface. For Ethereum, the narrative is clear. The supply on exchanges has fallen to its lowest level ever recorded. Staking continues to grow. Institutional demand remains strong, especially with the potential for a staked Ethereum ETF still being discussed. And when supply is tight, even modest demand creates outsized price reactions. That's why Ethereum is such a natural rotation target. Smart money looks at the supply dynamics and sees opportunity. Solana, on the other hand, offers speed. Not speed in the transactional sense, though it has that, but speed in market responsiveness. Solana's rebounds tend to be sharper and faster than Ethereum's at this phase of the cycle. When institutions want exposure to beta, the more aggressive upside, Solana is the go-to choice. And the ETF inflows into Solana products this week reflect that exact appetite. XRP's case is different. XRP is heavily narrative-driven, and the market knows this. With ongoing clarity around its regulatory status and a long-standing base of dedicated holders, XRP responds very powerfully to positive liquidity shifts. It also has ETF interest building as well, with recent filings renewing speculation about a potential Ripple ETF approval path. When you put that together, XRP becomes a strategic rotation target for institutions seeking diversification beyond Ethereum and Solana. So the rotation makes sense. But the rotation isn't random. It's happening because institutions believe the worst is behind us. They believe the November flush was the capitulation phase. They believe the Federal Reserve is approaching the point where liquidity will gradually ease again. And they believe that holding only Bitcoin is no longer the most efficient way to capture upside. Another important factor is the relative performance gap. Even though Ethereum and Solana have moved recently, they are still far below their cycle highs compared to Bitcoin. Market cycles tend to favor assets that lagged after the leader recovers. That's why Bitcoin maxis often get frustrated during rotations, because once Bitcoin stabilizes, capital seeks higher multiples elsewhere. And that's exactly what we're seeing now. The beauty of this moment is that the rotation is early. It is just beginning. And early rotations are the cleanest to analyze, because they are data-driven rather than hype-driven. Early rotations show up in ETF flows, stablecoin deployments, exchange balances, funding rates, and macro conditions long before they show up in price charts. Today's ETF inflow data into Ethereum, Solana, and XRP is one of the clearest early signals I've seen all month. Combined with improving global liquidity, rising stablecoin activity, and institutional positioning ahead of the Federal Reserve meeting, it forms a complete picture. Now, to understand what comes next, we need to look at how previous cycles behaved. Historically, early altcoin rotations begin with the large caps, the assets that institutions feel comfortable placing size into. Then, if liquidity continues improving, the rotation widens, first into mid-caps, then into small caps, and finally into the speculative layer. But that only happens if the macro environment supports it. If liquidity dries up, rotations stall. If the Fed surprises the market with a hawkish message, rotations unwind. If Bitcoin dominance suddenly surges again, rotations pause. The early rotation we're seeing today does not guarantee a full alt season, but it does guarantee that institutions are positioning for the possibility of one, and that alone is powerful. So what should listeners watch over the next 72 hours? First, ETF flow updates. If Ethereum, Solana, and XRP products continue to draw inflows, while Bitcoin products see mixed flows, the rotation remains intact. Second, stablecoin inflows. If USDT and USDC continue rising on major exchanges, that means fresh capital is still entering the system. Third, Bitcoin dominance. If dominance drops as Bitcoin consolidates, that is textbook rotation behavior. Fourth, volatility. Rotations thrive in low to moderate volatility environments. If Bitcoin suddenly becomes extremely volatile again, rotations slow down. Fifth, of course, the Federal Reserve decision. Even a neutral tone supports rotation. A hawkish shock suppresses it. The bottom line here is that the rotation has started, and it started exactly how smart rotations always begin. Quietly, data first, and driven by institutional behavior rather than retail excitement. Whether this becomes a full wave or remains a controlled shift depends on macro conditions and liquidity in the days ahead. But the signs today are undeniable. The majors are seeing inflows. The environment is improving, and smart money has made its first move. Whatever happens next, this moment will be remembered as the point where the market shifted from recovery to repositioning. And as always, we'll see you at the top.